You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell securities or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options, and the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out www.optionseducation.org. Now, here's your host, OIC's Director of Retail Education, Ed Modla. It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
Joining me on Strategy Spotlight today is Patrick Ceresna, the founder and Chief Derivative Market Strategist at Big Picture Trading. Patrick is also the co-host of the Macro Voices and Market Huddle podcast. Patrick, I'm very pleased and excited that you're here with us today. I've heard you speak before. You're an excellent educator, very involved with the markets. You really know your stuff, so thanks for making the time for us today. If we could just start with a little bit about your story. I want to hear about your background, how you got started in the business, and how your career has evolved up to what you're doing today.
Well, Ed, thank you so much for having me on the show. And so my career started off right out of school at a big bank up here in Canada at CIBC. And I worked in different trading roles over 10 years. But really what got me into options was when I had the opportunity to work with a portfolio manager that had me managing a big pool of cash that was just dedicated to premium harvesting and option writing. And that's where I cut my teeth on this stuff and got to learn the options market in great detail. After a decade there, I spun off and got into different educational roles, running different trading companies, and including over the last 10 years, I've been one of the lead instructors at the TMX exchange up here in Canada, educating about options. And so that's where I had the opportunity to meet you and speaking at many of those events, right?
Yeah, absolutely. Yeah, and again, I've worked with you in the past, not just in person, but also on podcasts, and You're always bring an excellent level of insight into the options business and different strategies. And I know we want to get into a different couple of strategies today. I want to pick your brain a few times. And the first one I want to start with you is with the collars. There's some really interesting things I know you have to say about collars and product-specific points you'd like to discuss. Well, let's just sort of take a step back to the ground floor for our beginners or those listening who may not be savvy options investors. And what conditions lead you to the collar, and how is the basic structure of the collar? Let's start there, and then we can take it deeper.
The collar is a great strategy. I mean, it's also known as a hedge wrap, and it's basically, it involves you physically owning the share. So the premise is really that these are option overlays over an underlying security that you own. And the whole point of it is that, well, you're going to buy some puts as insurance to remove the risk of loss beyond the strike price that you bought. So that costs money. And so the question then becomes, when you're paying money for this insurance, how do you reduce the cost of being hedged? And one of the more popular ways to offset that is by selling covered calls above on your security to generate an income to help often finance some or all of the cost of buying that put protection. Is that a good way of putting it, Ed?
It is, and the way you're describing it makes it sound like it's predominantly a risk management strategy. So let me ask you there, when you have two strikes here along with the stock position, how are you making those decisions on what strike? Are you focusing on the calls first, the puts first? Are you going a certain level out of the money? How do you put that together?
Right. So, well, what is interesting is actually this strategy may very well be the best general stereotype of the composition of index options trading in general, which is that it is incredibly popular to be selling and overwriting call premium above to harvest income. At the same time, buying tail risk insurance for a market crash is while you're heavily long or leveraged the market is also incredibly popular. So dealers often find themselves in a situation where the dealers long calls because everyone's short the calls above. At the same time, they're often selling the puts to buyers. What this does is it creates what we identify as a left tail skew in the options market, which creates a scenario where actually calls for, let's say, something as broad as the S&P 500 are relatively cheap. And as an example, let's say right now on the SPYs at the time we're recording are being priced in the 10 to 12% vol premium. At the same time, so if you, let's say, were to sell a covered call 5 or 10% out of the money, you're getting priced at a very low vol premium. But at the same time, to buying a put option, let's say 5 or 10% below the S&P 500 market, you're being priced in a 15 to 20% vol. And which basically, to summarize, it means that often you'll find that the put is even 2 times or more expensive than the call income you can make above. And this often creates a skew that it makes it not favorable to open the collar in normal conditions. Often it's a tactical period where you feel that you need the protection because you're going to often overpay for the puts. Is that a good way of putting it?
Yeah, it's getting really interesting now, and I'm loving the way you're taking this with the volatility discussion, the left tail skew, basically saying that your puts are going to be more expensive. Now, as far as strike selection, that also would mean you're going to have to go a little bit skewed against you to buy your puts and sell your calls because the puts are going to cost more. So the level of out of the money or moneyness of your calls is going to be different than that of the puts, and the moneyness will not match up. But it's not always the case. I know you trade a lot of different products. What are some specific products that you have found yourself using collars on, and are those skews always like that?
Well, this is the beautiful part, and I'm glad we're going down this direction because for most kind of beta 1 securities that have a good strong correlation to the indices tend to have that fat left tail, and opening collars in an asymmetric way where the downside risk versus the upside potential is skewed in your favor is always difficult to do, at least at a zero cost. You usually have some capital outlay some form of a debit in order to skew the asymmetry in your favor. But what is amazing is that that's not the case on all securities. And particularly many of those securities that are considered by most market participants as risk-off assets, those things that tend to get a lot of attention when stock markets are in turmoil, things like volatility as the VXX or volatility index or gold or treasury bonds, often actually have really interesting right tail skews. In the case of treasury bonds, it's a really nice smile on the ball skew. But in the case of things like gold or volatility, you have these really fat right tails. And what's interesting, to simplify that for those that don't understand what this language that we're talking in options, it really means that you can be paid a very rich covered call premium that more than offsets the cost of the put and often allows you to create some really interesting skews. So as an example, let's take gold. I was at the Vancouver Resource Conference talking about the idea of putting these types of collars on gold. And what's interesting is an example, right now going, let's say, 5% below on the GLD, it's being priced at buying a protective put on a long gold position is being priced at a 10% vol premium. At the same time, you go out even 10 or 15% higher on a covered call. So we're going 5% below on the put. Going 10 to 15% higher on the call, you're being priced at a 15 vol premium and a very rich covered call income coming in at much higher levels. And so you can pretty much open this collar at almost zero cost around something like gold or silver or treasury bonds and things like this, and yet build the asymmetry where you have more upside potential if you're right, and very small and manageable downside risk because the put is much tighter to your strike or to your price level of your underlying.
Yeah, so you've got this different skew you're talking about now in the risk-off assets. Now, for clarification, many of our listeners may trade these various products and many may not. As far as the right tail skew, how often, if ever, would you expect to see that in your traditional equity markets? Does it ever occur there, or is it only in the products you listed?
Well, it's interesting because right now, at the time when we're recording, we're going through a very robust bull market advance in the stock markets. And what's interesting is the stocks that have been the kind of generals, the ones that have been running this rally, like this melt-up in Tesla that we're witnessing, has actually created a right tail skew on Tesla, let's just say. So what's happening is that the Tesla's going up so fast that the vol premium having to be priced in on out-of-the-money call options is actually creating very rich and expensive call premiums there. So in those situations where some of these individual securities get really hot, you will see that right tail develop. But it's very rare to see it in the broader S&P 500 or on some of the indices. You have to get to some of the individual stock names that are really frothy.
Yeah, many of the investors that I speak to or teach to are familiar somewhat with volatility skew and the volatility curve, and when this concept of having the inverse or what they're not expecting to see sometimes occur with the right tail that you're describing, it's really a fascinating discussion. Back to the collars now, you've got different possibilities for the out-of-the-moneyness or the moneyness strike price that you're going to be choosing. I want to talk position management there. You know, the stock's going to be moving around. The risk is to the downside. We're protected, but we still make money on the upside. When you execute these trades, Patrick, are you holding through expiration, knowing that your options are in place? Are you tracking the underlying and possibly exiting proactively or rolling your positions? How are you managing it while the trade's open?
Well, the one thing, hence the name of my company, Big Picture Trading, we're really not day traders. We're not actively managing this day in, day out. We basically open positions based upon the idea that we want a meaningful swing in the markets that often take multiple weeks, if not months, to develop. And we really want to see a bigger pronounced move. And so when we put on a collar like this, in fact, it's a really amazing situation because if, for instance, the market goes against you, we were just talking gold, so let's just stick with that for a moment, and because since we already kind of built that scenario. Well, I've built the collar around a long GLD position because I actually want gold to go up, right? I'm along the shares. But what's amazing is once you insert the collar, you actually have defined your worst case scenario or on the downside. So in fact, if the trade starts to go against you, it's this actual funny thing that you do is you actually then are cheering the stock to actually go against you really hard. Like if it's going to go down, it might as well crash because you've already locked in, let's say, a sale price 5% below. So if, let's say, gold was to drop 10 or 15% or something lower, you actually have hedged out a huge chunk of that downside risk. And you can basically sell higher and then buy your entire position back, if you still like it anyway, at a much more favorable price. So we often are not actively adjusting, at least on the put side, the moment it's going down. We actually often will see whether or not a position really gets moving and allows us to tactically reposition at a more favorable price. But it's a little more opposite on the call side, because if you sell a covered call, you obviously want to build asymmetry in the trade, which is you want more upside potential than the downside risk. And so often if the problem you have is the stock is going up too quickly and it's approaching the top end of the call, you'll have to take a loss and roll up the call strike to a little bit of a higher strike to continue to give some further upside. But that's usually done at a debit, so you're changing your risk profile a little bit. But often it may be worth it depending on what your forecast is on the position, right?
Yeah, I really like the way you described that downside. A lot of investors might put the position on. They know what the risk profile is, and they sort of lead it there. But you're exactly right. If the stock does start to move lower and your insurance kicks in the form of that put strike, might as well go all the way down because it's going to provide you with a better opportunity to get back in. So very, very well described there. I do want to shift gears a bit and pick your brain on another strategy. I know it's one of your favorites, which is ratio spreads. And let's just stick with the bullish thesis. Can you start defining what is the ratio spread? If you have you can use it in either direction, but if you're bullish, what would the ratio spread look like, and how is it put together?
Well, so let's specifically talk about a ratio call spread. Obviously, there's ratio put spreads, and there's different conditions. But I want to specifically address the ratio call spreads. We have a bullish slant on the market, and the stocks that are most favorable for a ratio call spread are the ones like we talked about earlier that have the right tail skew very flat. They have the fat left tail, which is very typical of what you'll see on the S&P 500 or any of these types of stocks correlated to the market. But then they have a very flat right tail. The volatility is very low on the calls out of the money. And what is really amazing about putting on this trade, it means that out of the money call options are actually relatively cheap relative to the at the money or in the money ones. And so you create a scenario like in today's market where the stock market is roaring higher and you see all this money made and you want to get a piece of the action and you want to find some way of participating further on the upside of the market if it keeps ripping. But at the same time, you know that this is not going to last forever, and you don't want, when the musical chair stops and the market has its legs kicked out from underneath it, you don't want to be stuck holding the bag and taking a loss because you were chasing the market in the ninth inning of an advance. And so the ratio call spread is amazing to me because it's a great way to continue to participate. And because the principle behind a ratio call spread is to open as close as possible to zero cost, it means that if the trade goes completely against you, you actually lose almost nothing. If you did at zero cost, you lose nothing. And so it's an amazing thing. So let's break down what it is. And so the ratio call spread, the way I like to teach it and educate it is that we start off with the credit spread, a call credit spread. So you're selling, let's say in this case, an at-the-money call, and then you buy a higher strike call option. And normally, what people open call credit spreads for is income, right? You receive a credit and you make an income. But what the second leg of a ratio call spread is to take the credit income you earn, and then you turn around and spend the credit to buy more of those out of the money call options. What this actually does is it puts you in a situation where you are long some solid gamma on the upside of the market. Often, as an example, you can ratio this 3-to-1 or even 4-to-1 in terms of the number of call options you can buy for the short call premium that you received. And what's amazing about this is if the stock market keeps ripping to the upside, then your long gamma, which means you're going to be able to continue to participate. But because you are actually flat, the credit you received for the at-the-money call paid for all of the out-of-the-money calls. So the credit you received for the at-the-money paid for all the out-of-the-money calls. If the stock market reverses and starts nosediving lower, you did this at zero cost, and all those calls and just all expire, and you lost nothing, right? And so it's a really interesting way of participating on the upside of the market in these stages.
Yeah, it really is. And so you're short an at-the-money call the way you described it, and then you reach up to a higher strike, and you are basically using that credit to buy a certain number of out-of-the-money calls at a higher strike. So you're going to be net long options with really no downside risk. If I'm hearing this correctly, your risk is if there's a mild or modest move higher. So let me just ask you a little bit about that. If you're selling an at-the-money option, how far do you like to go up in strike price, knowing that if the stock moves up to your short strike or moves up to your long strike and stops there, that's where you lose. So how far up do you usually find yourself going for that strike? And of course, in order to make money, the stock's really got to start ripping higher. So what kind of composition there on strike prices do you normally like to look for?
Right, and so you're absolutely right. So this only really works in a period where you think that there was a chance of a market rip going higher the way we're experiencing over these last couple months, which is you have to be anticipating a really good bull run because the real pickup in the net delta happens once the out of the money calls start getting in the money, right? That's where you're going to really get the big payoff once we surpass the top of the strike. So this is one of the strategies that essentially you have to be really uber bullish something. It's not enough that it goes up 5% on the underlying. This is the wrong strategy to profit from a mild appreciation in a stock. And so the first criteria on any ratio call spread is that you have to be really bullish the security, and you have to believe that within the time frame you're opening the trade, that bullish move will manifest itself. And that criteria is there. But so that will vary, obviously, in terms of how many strikes higher you go. Depends on the volatility of the underlying. Usually, as an example, I'll sell a 50-cent delta at the money call, and I'm usually buying 20 to 25 cent delta calls higher. And often you'll be able to get something very close to a 3-to-1 ratio where you own 3 call options for 1 short call. And you're able to do that pretty much somewhere near a net zero. Sometimes it's a small debit, sometimes it's a small credit. It's never going to always be a perfect wash, but you're trying to get something as close as possible to zero cost outlay in terms of cash.
And so now we have long options, short options. For anyone who's trying to figure out what are the Greek exposures specifically with respect to time decay and volatility, what would you say about the ratio spread? Are those exposures significant or mitigated, or what do we have to be concerned about in that respect?
Well, from a theta perspective and from even a vol perspective, you're short options against the long options. So what happens is that whenever you're in any spread trade, some of those Greeks actually are mitigated a bit more than something that is just pure long, right, which is going to get much more exposure to those Greeks. And so whenever you're short one option, long others, then you're going to actually mitigate many of the Greek factors in there. But the real takeaway from a ratio call spread is your long gamma. And what you really want is a meaningful rally on the upside. The other thing that is overlooked on the ratio call spread, and I want to leave all of your listeners with a nugget, the max risk points, when you plug this into any calculator and you see that V shape where the max risk is on a ratio call spread, that can only actually ever be reached at expiration. And so often the max risk point, even 2 or 3 weeks before expiration, is actually a much smaller risk than the risk at expiration. So as a general rule of thumb, you never ever want to hold a ratio call spread to maturity. So it's one of those things you put on and you usually take off without ever holding it right till the expiration date. And that actually mitigates a lot of the additional risk.
Well, that's great insight. A lot of investors sometimes forget about that as you're looking at profit and loss diagrams and max risk and break-even points. You're absolutely correct. Those are drawn with specific numbers at expiration, but most options never live till expiration. Things are quite different prior to that, and tracking the position along the way is critical. So we've talked collars, we've talked ratio spreads, got into a lot of great details on both. Thank you very much for all of that. Any final thoughts for our listeners about what you're up to today or the business that you're doing at Big Picture Trading?
Well, at Big Picture Trading, we're putting on all sorts of really awesome trades. The key thing that we do at Big Picture Trading is hence the name, we're looking for bigger positions trades. We're not messing around for day trades or weekly. Well, we sometimes use weeklies as hedges, but generally our every narrative is a macro-driven top-down one that we're looking for bigger asymmetric trades to develop. But what I wanted to just bring to everyone's attention is the great podcast that we have, both Macro Voices, where Eric and I talk to all sorts of amazing macro thinkers, and then the Market Huddle, which is where we talk to a whole bunch of traders. Kevin Muir and myself have guests such as yourself on when we just talk markets. And for all the listeners, if you go to the Market Huddle and just look up episode 55, we had Ed on the show and we talked options, right, Ed? It was a great episode, and it's a great one to go back. But the other one I want to bring to everyone's attention, another Market Huddle podcast that we did, episode 63 back on January 18th, was a great interview with Brent Kochoba from Spot Gamma. And we were looking at the actual gamma profile of the S&P 500 and in regards to dealer exposures and the influences on future selling in order for all these dealers to remain delta neutral on their positions and the impacts that it has on markets. It was such a deep dive into this topic, and it's just an amazing episode that is for those that are into these options would get a lot of value out of.
Yeah, you do a wonderful job with that podcast. It was very enjoyable to be a guest on that show, so thanks for bringing that up, and I would definitely encourage our listeners to visit Big Picture Trading and listen to those podcasts as well. As Patrick said, Market Huddle, episodes 55 and 63, start off there and listen to the rest. Once again, thank you very much, Patrick, for taking the time to be our guest speaker on Strategy Spotlight today, and that is today's Strategy Spotlight.
Thanks, Ed.
Ready for a little nostalgia? It's time to take a look back.
I want to look back on the year of 1973 and everything that occurred during that year. It's arguably the most important year in the history of the options business. We had the launch of the Chicago Board Options Exchange. Standardized contracts were now listed. Clearing Corporation was launched and founded, and also pricing models. All of that I will get to and elaborate on. But first, it's most useful to look prior to 1973. Options could still be traded at that time. However, they weren't listed. They weren't traded on an exchange. You had to call up a counterparty and negotiate terms between the buyer and the seller. More specifically, investors are probably using their brokerage firm, and that broker was calling up other firms, deciding and trying to figure out if there was another side willing to sell this option or purchase this option from their client. And often at that time, there was also advertisements in the newspapers being put up to try and solicit business and try and solicit the other side of the contract. Once that trade was executed, those two parties, the buyer and the seller, were tied to each other. And if you had bought a call option from someone, the stock rallied, and you wanted to exercise that into shares, you had to get those shares from the person that sold you the option contract originally. if they didn't have the shares, if they couldn't obtain them, if they were out of business or weren't financially capable of fulfilling their obligation, you really were out of luck. And that is what is known as over-the-counter trading, and that's what options were prior to 1973. In the late 1960s, the Chicago Board of Trade began looking for different revenue streams and a way to expand their business, and that's really what led to the launch of the Chicago Board Options Exchange. An interesting detail, the first trading floor of the Options Exchange was the former Smokers Lounge in the Chicago Board of Trade building. People joke that it was a very large room because there was a heck of a lot of smokers in the trading business at that time. So that was the first trading floor where 16 stocks had options. They were only calls, and they were standardized, meaning the terms were standard, 100 shares, and expiration dates were identified within the contract. You could select the one you wanted, but those terms were not negotiable. They were standard. On the first day in business at Cboe, 911 contracts traded. It didn't take long for the industry to start to grow. By mid-1974, so about a year later, about 20,000 contracts a day were trading. So the growth of the industry did not take long. Also, all of these contracts were cleared by the Options Clearing Corporation, also founded and began to operate in 1973. The Options Clearing Corporation, otherwise known as OCC, performs a multitude of functions within the industry, but at the forefront of that, it eliminates that counterparty risk that you had from over-the-counter trading. OCC clears the contracts. What that means is it takes the position of being the seller to every buyer and the buyer to every seller. It jumps in between the two parties and severs that link. Then OCC proceeds to manage risk of each firm involved with having an open short position and long position, managing their financial condition, charging margin when required, and guaranteeing that obligations of shorts are fulfilled. That's the role of OCC. And when you put together the listed exchange along with standardized contracts and clearing, you now had fungible contracts. So you could buy an option from one person and sell it to somebody else. That's because OCC clears the contracts. You also had Black-Scholes being first published in 1973. Before this, the method for pricing options was very vague. Buyers and sellers just came up with what they thought was a fair and decent value for the option. Black-Scholes took all of the inputs, so we're talking strike price, the stock price, a volatility assumption, days to expiration, dividends, if any, and it put these inputs into a model to derive an options price. So now you have some format or some ground floor for investors to identify what they think an option might be worth, and this greatly helped investors feel more confident in the prices that they were getting. They were able to execute more freely and, of course, feel that they were getting a more fair execution price. All of this happened in 1973, the launch of Cboe, standardized contracts, clearing of contracts, and Black-Scholes. The expansion of the business did not take too long from there. More exchanges. The listing of put options came on board in 1977. Fast forward all the way till today, and we are doing over 21 million contracts a day. And that is today's Looking Back.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
It's important for every investor to be aware of the economic calendar, what news is going to be released. There's a very good economic calendar at Benzinga. That's benzinga.com. This website as a whole has a lot of information. They term themselves as having actionable trading ideas and real-time news. It's really a financial news and analyst website. It's really a financial news and analysis website providing timely insight for investors. You can choose from a number of different markets, of course, stocks, bonds, options, futures, commodities, but they also have a lot of articles and news on cannabis and crypto and others. Their calendar at benzinga.com/calendar/economic is really nice. You can view today's, tomorrow's, or look weeks ahead. But really what's important here is this includes news from all around the world with release times and estimates with previous results. You'll get all the information you need. It also includes a display, which is an indicator showing the level of importance of that particular announcement. Because it's worldwide, it's a very long list, but you can be pretty comfortable knowing nothing is going to be left off that list. A very good resource to check who you're in business with is FINRA Broker Check. Self-defined on their website as, quote, Broker Check is a free tool from FINRA that can help you research the professional backgrounds of brokers and brokerage firms, as well as investment advisor firms and advisors, end quote. It's very simple to use. Simply enter the name of an individual or an organization that you're trying to research along with their location, and you will retrieve a summary of their background, their credentials, current registrations, licenses, their employment history, and perhaps most noteworthy of all, an entire section devoted to any customer disputes or disciplinary events that have taken place against that individual or business. Where you have your money is of the utmost of importance, and you want to make sure that it's with the right people. Using FINRA Broker Check can help you with your due diligence. And if you're looking for a good read, I would highly suggest Trading Option Greeks, How Time, Volatility, and Other Pricing Factors Drive Profit. This was written by Dan Passarelli, originally published in July of 2008. Dan starts with the basics of options, rights, obligations, and really sets a foundation for your options knowledge before he moves quickly into the philosophy surrounding the Greeks. He provides a very clear definition of volatility and how it relates to option price. There's a lot of strategy discussion in this book: volatility selling strategies, vertical spreads, calendar spreads, diagonals. He also outlines delta neutral trading, otherwise known as dynamic hedging. It's a fascinating discussion. Then Dan finishes up this book with some comments and insight of his own from his many years in the business as a market maker, a trader, educator, and mentor. It's a very good read. Again, Trading Option Greeks, How Time, Volatility, and Other Pricing Factors Drive Profit by Dan Passarelli. That's today's tools, resources, and good reads.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
Taking your questions on industry happenings. I got three really good ones today. First from Jay Bird. I bought calls on a stock today and I'm losing money even though the stock is up. What is happening? Very common question that comes across my desk, especially around earnings. Remember, you bought calls. The stock moving higher has a positive influence on the call option value, but doesn't necessarily mean that the value is going higher because there are other factors, notably time and volatility. Sometimes there's not a whole lot of time that has passed, just 1 or 2 days, and the investor knows, well, time hasn't passed. That's not the reason. Inevitably, the reason is the implied volatility assumption within the option itself has changed. It's very important for investors, whether you're buying or selling, to at least look at what is the implied volatility level at the price that you initiated the opening position at. Even if you don't have an opinion on whether that implied vol level is high or low, be familiar with where it is and track it during the life of the contract. In cases like this, you would likely have seen that even though the stock has gone up, the implied volatility assumption being used within that option contract is much lower. Frequently, that's due to an earnings or other announcement, and that is what's driving the call price lower. Question 2 from PLC4, is there a such thing as too much hedging? How many puts or how much of my portfolio should I allocate towards this strategy? Well, I would never answer by saying there's a such thing as too much. Each investor can decide for themselves how much of a hedge they'd like to initiate, maybe 25% of your position, 50%, or 100%, or you can even go more than 100%. If you wanted to be overly protective, that's similar to buying more insurance than you need. And if there is a correction in the market, you can actually profit off of something like that. With respect to how many puts you're buying, it's pretty straightforward. When you have an equity position, you know that each put you buy is on 100 shares of stock. So for a position of 500 shares, you can decide how much do I want to protect. One put option would just be 20%. 5 put options would be the whole thing. You choose for yourself. If you're protecting an entire portfolio, it's a little more complex. If you're choosing, say, an index option or an ETF option to protect your entire portfolio, what you have to do is first decide how much dollar value are you trying to protect and what option would you like to purchase. From there, it's simple calculation. You want the aggregate value of all of the put options you purchase to equal the dollar amount you're trying to protect. So quick example on that, if you're just looking at an ETF that's trading at $100 a share, and you're going to use that put option, the 100 strike put option, to protect your portfolio, buying one of them would protect $10,000 worth. That's the aggregate value, $100 times 1 times 100. Strike price times 100, that's the multiplier times one option. If you bought 2 options, you'd be protecting $20,000. If you bought 5 options, you'd be protecting $50,000, and so forth. Each investor will decide for themselves. And the last question from Cannon, do you think the elimination of commissions will change the way people trade options? Really tough to answer this question, but certainly you can say the elimination of commissions has changed the cost structure in the business. So it's a fair question to ask. There could be some changes in the way or the quantity that investors trade with respect to how often they're using options or how likely they are to now go into multi-leg spreads and different complex strategies. It's important to note that even though commissions on trades may be coming down and have gone to zero, not necessarily the case with options on a per contract basis. So be very careful that you track and you're very aware what your firm charges, not just commission, but on a per contract basis, because that may still be there. But we'll see moving forward how that cost structure may also evolve over time and what the effect is on the industry. Great questions today. Keep them coming in. And that's today's Industry Happenings.
You've been listening to the Options Industry Council's Wide World of Options. If you have any questions about anything you've heard on today's show, email Ed Modla at options@theocc.com or visit www.optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation. And follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.